Welcome dear friends, in this video we will solve objective part of CSS Accountancy and Auditing Paper 2 of the year 2026. Management provides detailed explanations for unusually high year-end sales, supported by invoices but not matched by dispatch records. What should the auditor focus on first? Cut-off testing for revenue. A company uses strong automated controls but bypasses them during system updates, relying only on manual approvals. The greatest risk arises from unauthorized transactions. A taxpayer depreciates machinery at accelerated rates while claiming repairs as revenue expenses. The tax officer should assess whether expenses result in double deductions. A trader claims full input tax despite selling a portion of goods at exempt rates. The auditor's primary adjustment should consider reversal of input tax on exempt supplies. A firm's WACC decreases despite rising interest rates in the economy. This is most likely due to reduction in business risk premium. A project A has a higher IRR but a lower NPV than project B. The firm should choose project B because NPV reflects actual value creation. A company decentralizes operations but keeps financial decisions centralized. The resulting issue is most likely imbalanced authority responsibility structure. A client's gross profit margin rises sharply while purchase prices remain unchanged. The most plausible audit concern is understatement of cost of goods sold. A company pays commissions to agents but records them as marketing support. The primary tax risk is avoidance of withholding liability. A portfolio's beta decreases after diversification, but its standard deviation does not fall significantly. This suggests unsystematic risk already minimized. A multinational transitions to an ERP, but legacy modules still process adjustments during peak periods. Audit logs show inconsistent user IDs creating overrides, some from unusual IP ranges. Which risk dominates? Fraud risk from unauthorized access. A client with declining cash flows capitalizes development costs aggressively while lenders tighten covenants. What is the best audit response? Perform sensitivity analysis on assumptions. A consultant spends 160 days in Pakistan but earns foreign income routed through a Pakistani bank. He claims non-resident status. What is the core issue? Whether physical presence triggers residency. A textile firm records luxury travel for foreign buyers as entertainment. The tax officer must assess whether Section 21 disallows it. A manufacturer sells partly to wholesalers and partly to unregistered retailers. CNIC reporting mismatches cause discrepancies. Key concern: incorrect apportionment of input tax. A firm with volatile EBIT uses high leverage assuming tax deductibility offsets risk. Falling margins expose fixed interest burdens. The error relates to misreading tax shield. A long-term project has low early inflows but a huge terminal value. Management selects a low discount rate to approve it. Flaw: understating a risk-adjusted discount rate. Payroll testing reveals identical salaries for sequential employee IDs created within days. HR calls them seasonal workers. The auditor should consider potential payroll fraud. A construction firm subcontracts work involving the supply of material and specialized installation service, treating the entire payment as subject to final tax (FTR) under Section 153. The tax officer's primary task is to assess whether the payment for services must be separated from the payment for supply to supply the correct withholding tax rate and determine the final tax status. Management changes costing assumptions mid-year without documentation, affecting product-level margins unevenly. Which assertion is most at risk? Accuracy or valuation? Thank you for watching this video. Stay blessed.